This video is an overview of the taxation of income or loss from a trade or business owned by one individual taxpayer. The definition trade or business and the focus on a single owner are important distinctions. What is a trade or business? Tax law, IRS regulations, and court decisions state two essential factors. First, the taxpayer must have a good faith intention to make a profit. Demonstrating a profit motive distinguishes the activity from a hobby. Trade or business expenses are deductible, while hobby losses may be limited or disallowed entirely. The second factor relates to the scope and effort expended in running the business. To qualify, taxpayers must demonstrate considerable, regular, and continuous activity. Special rules apply to taxpayers who trade stocks. Traders should consult their tax advisor for more details. Other notable factors are having a business plan and maintaining a separate bank account. Trade or business includes working as an independent contractor. The taxable income or loss of an individual engaged in a trade or business flows through to their personal tax return. Let's explore some of the pros and cons of running a trade or business as an individual or as some form of corporation. The most prevalent way for an individual to operate a trade or business is as a sole proprietor. They may work under their own name or by doing business as a fictitious name registered with the appropriate authority. Simply put, sole proprietors run the business out of their own wallet. A legal claim against the business is a claim against the individual owner. Corporate form may offer individual business owners a degree of protection from personal liability. Your attorney can tell you more about this. The three most common corporate forms include a regular corporation formed under Subchapter C. However, an individual owner or owner-employee of a C corporation is not engaged in a trade or business and may not personally take business deductions. The C corporation is considered to be a person in its own right and files its own tax return. Its income does not flow through to the individual owner. There are many financial, tax, and legal considerations related to C corporations that are beyond the scope of this video. Consult your tax and legal advisors to learn more. There are two other common types of corporations self-employed individuals may consider. They are both hybrids that offer protection in the manner of a C corporation, but whose income does flow through to the owner's personal tax return. These are a single-member limited liability corporation, or LLC, or a Subchapter S corporation. The taxation of both LLCs and Sub-S corporations is similar in many respects. However, important distinctions between them include self-employment tax considerations and the number and type of shareholders allowed. There's a bonus. Taxpayers may use the new Qualified Business Income Deduction, or QBID. It allows you to deduct up to 20% of your qualified income and not pay tax on it at all. Tax law allows the deduction of ordinary and necessary business expenses. It's not as simple as it seems. Recognition of income and expenses is guided by the matching principle. It requires that revenue and any related expenses be recognized together in the same reporting period. If you are dealing solely in cash, common sense tells us that you have income when you receive it and an expense when you spend it. However, if you make sales on credit, such as no money down and months to pay, or if you pay your own expenses over time, you should evaluate the choice between electing the cash or accrual method of accounting. Consult your tax advisor about these methods, particularly if you buy and sell goods from inventory or have contracts to deliver work in stages over time. Here's an example. Imagine your business is operating a food truck. When you buy perishable ingredients, you would typically recognize an expense when you buy them, because they will either be consumed while they are still fresh, or you will need to dispose of them when their shelf life expires. What about the cost of the truck itself? You would expect it to last for many years. We call this the useful life of the truck. The cost of buying this long-term asset would be depreciated over that useful life. If you borrowed money to buy the truck, you would annually recognize the interest expense only on payments made during that year, and, importantly, keep a log of the business miles you drove. Please provide your tax preparer with the cost of purchasing a long-term asset and the date you started using it in the business. If you leased the asset, please supply these details as well. Here are some other considerations. Self-employed persons may deduct the cost of health insurance and retirement plans. If you have a business meal with clients, keep a log of the date, the attendees' names, and business purpose. You should document the same information for out-of-town travel and lodging. Business owners and independent contractors may deduct automobile and cell phone expenses. Track the percentage of time the sellers use for business and the average monthly expense. To report your automobile business mileage, first determine your principal place of business. This is the place from which you work most of the time. If you have an office, then your principal place of business is your office. If you work from home, then your principal place of business is your home. You may deduct the cost of a home office if the space is used exclusively for the business, whether you own or rent. There are two options for taking your home office deduction: the simplified method and the standard method. Under the simplified method, you may claim $5 per square foot of office space up to a maximum of 300 square feet or $1,500. The standard method uses actual expenses, which may give you a higher deduction. Tell your tax preparer the number of square feet for the office and the total square footage of the residence. Provide your tax preparer with the total cost of buying or renting the home, the date you first used a portion as an office, the expenses directly related to the office, and the total indirect expenses to keep the entire home running. If you have employees or use independent contractors, you may deduct your payments to them. You are obligated to provide employees with W-2 wage statements and make payroll tax payments on their behalf. You must file a Form 1099 miscellaneous for each contractor whom you paid $600 or more during the year. It's very important to have current and accurate books. As a manager, you want to know how well your business is performing. As a taxpayer, you need to retain your records to defend the income and expenses reported on your tax return in the event of an IRS inquiry.